question number 2. So the question is, 𝐿𝐿𝐶 Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿𝐶 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿𝐶 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶 Limited, a public limited entity, public limited entity. Effectively, 𝐿𝐶 Limited purchased 50% of the equity shares of 𝐶𝐶 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿𝐶, Paper, and 𝐶𝐶. We have the statement of financial position for the 3 companies, that is 𝐿𝐿𝐶, Paper, and 𝐶𝐶. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure, that's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿𝐶 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company, on 1st April 2024. So the company which is called 𝐿𝐿𝐶 Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿𝐶 is the parent, and then Paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿𝐶 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶 Limited, a public limited entity. Effectively, 𝐿𝐿𝐶 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶 for an immediate cash payment of 15. So this company here, we are told, acquired 50% shareholding in a company which is called 𝐶𝐶 Limited. 𝐶𝐶 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary, Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐶𝑠A. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually we said once the subsidiary company revalued the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which we are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment, and basically this is the adjustment in relation to the revaluation gain or loss. But remember, you see in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. And equally this depreciation other charge will be by Paper. is by paper limited. So you need to recall the formula. There's a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April, 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful life. And I hope you can see that within note 1. Can you see the remaining useful life? How many years? In note 1, remaining useful life. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful life of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested with the depreciation under charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation under charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PP. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation under charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation under charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation under charge. Let's move to point number 2, where we are told 𝐎𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained that if you come across that information that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what? Method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiary are fake sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by Paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods would be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be, the margin will be 1 over 5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is Paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the three adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which 𝐎𝐿𝐶 Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in CISA were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary and recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is paper, paper limited, as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, and as a non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that point number, paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and 𝐓𝐿 Limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331 and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1. Remember the formula here. 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. These are reserved. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, these are the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51 what? 80. So remember, we are not consolidating their joint venture. So then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, to the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax? The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on the 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share of Sisters Limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always have 3 mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. These always have 3 mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation other charge of 70 over 70. Also, in case our goodwill was impaired. In case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 14 what? 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. Will it come to 121? Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a free mark. Income tax expense. Income tax expense, also this one, is always a free mark. A free mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. which will give us which will give us what? 1320, yes. So basically in our case, we are done, and that what was required, the marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically it should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B, the consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. Two adjustments here. Two adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year. CSAS was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed, and basically we record the current assets. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we said should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total assets in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a part. These are some of the items you don't have to compute in an exam. They will consume a lot of your time and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to recall that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables, for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast, very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam, and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Sasa, yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is LOC, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we are given the retained earnings of ROC, that 380. For paper, it is given as what? 1800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. That's yes. And I think for this, what we will do, for this company, I think we computed for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something we have already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition ya hii ni 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the sisters? Sisters, when was it acquired? I hope you can remember when sisters was acquired. Sisters was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for sisters, we need to have first of all its retained earnings at the end. Its retained earnings at the end for sisters is 12. The value which we have here. Let's be together here. And then we also need to have the profit for sisters for the year. That one we get it from the income statement. From the income statement, the profit for the year for sisters is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of sisters on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 all over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of sisters at the start, which you have said is this, minus this, which will give us 560. And then for me to compute the retained earnings on the date of acquisition, which is 3, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 8 what? 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and right value, what do we get here? We get what? 5 what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and today's profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have and today's profit that will also be deducted from the retained earnings of paper, 50, like that, like that. Do we have any other adjustment? I can't see any other. I can't see any other. So we need to get the final figures. That is 380. This one 2400. This is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent we take 100. For paper we take 80. And for this company that is the sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those 3 values. We add those 3 values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 3860. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 3860, which basically will give us 9360. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now to compute this, very simple. We take the NCI at fair value. And the NCI at fair value, which is basically given in note 2. the NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share law, the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary, which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we left here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No item to be a deducted share. So we add these two values and they give us 9 what? 940. So the NCI fair value here is basically 940, 940. But basically I'm saying if, although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this, because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. Ten bob. 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be, is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is the, what is the difference? Is the difference, is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 32, 70. And the retained earnings should be 3750. Yes, we should now balance. We should now balance. We should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here, because remember, these are an expense which the parent company was supposed to have accounted for. It's the parent company needed to recognize this as an expense, and that's why you can see in the income statement, the parent company didn't have a finance cost that was supposed to be captured here, and therefore even the profit which you have taken into account here, that was supposed to have been deducted, and because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned. And I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account. In relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it. Because now what I want us to do once we meet in our next class, we are looking now on special cases in group accounts. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday, we do foreign subsidiaries. So basically, we should be done with this next week. What we will be remaining with is the group cash flow. Is the group what? Cash flow. So because we have those three concepts which are remaining: piecemeal acquisition, the disposal of interest, and the foreign subsidiary. We will be able to take one class each, but basically we will be able to come back and look on this during our revision. So the question I want you to attempt is the question for December. The question for December 2022, which basically is question number 3. Question number 3. I want you to attempt this one. Maybe during our revision, we will be able to look on it. We will be able to look on that. We will be able to look on this. We will be able to look on this. Remember, what we said is that if everything goes on well, we should be done at least with this by next week, our first class. And then from there, I think what will be remaining is maybe the theories and maybe like the financial statements of the insurance company. Right now, we can say that we are almost like over 85% done with the syllabus. So I'm hoping that if everything goes on well, we should be done with this by next week, but one on Tuesday. On what? Tuesday. So let's stop at that point for today. You have a nice weekend and make sure you attempt that particular question. In case you come across any challenge, you can maybe get some assistance from me. Equally, if you're able to attempt the question, you can send it to me. I'll be able to check on it and give you the feedback. Sasa, yes, we stop at that point. Have a nice weekend. See you next week on Tuesday. To prepare financial statement. To prepare financial statement. And the financial statement prepared by these insurance companies include: number one, we have the revenue account. The revenue account. Number two, we have the general statement of a profit or loss, or basically the income statement. The income statement. And number three, we have the statement of financial position. So let's start by looking on what we mean by the revenue account. The revenue account. Now, the revenue account, basically, this is an account which is prepared to determine the performance of each insurance business. Assuming we have an insurance company which is maybe providing two insurance business, the life insurance and maybe the fire insurance. So those are two different insurance business. So the insurance company would like to know at the end of each year, how is each insurance business performing? So such an insurance company will prepare something called the revenue account. So therefore, this is basically prepared. This one is prepared to do what? To determine the financial performance of each insurance business. Of each insurance business. Of each insurance business. So how do we prepare this particular account here? I want us to look on the format, and then I will be able to explain how we compute a number of items. So this particular account is basically prepared using a vertical format. Using a vertical format, not the T format. So the revenue account. So assuming our insurance company basically undertake two insurance business, maybe like the fire insurance, or the provide two insurance business, the fire insurance, and maybe the life insurance. So basically in that case, we have two columns here. And when preparing this, always we start with the incomes, or basically the revenue from each insurance business, the revenue from each insurance business. So the first, or basically what we know, is that once you have insured a certain subject matter, you have to pay something called a premium to your insurance company. So this premium is one main source of income as far as these insurance businesses are concerned, the net premium. But in this case, we're going to look on how we compute this. Maybe we will have working one. Basically, we look on how do we compute the net premium, because that is something which the examiner will not have given you. You have to compute that. And then out to this, and basically what we know is that if, for example, you have insured a certain subject matter, you pay the premium in advance. You pay the premium in advance. For example, you own a car, you have insured your car, you pay the premium in advance. Some insurance companies may tell you, can you pay this in 2 installments? So, but you pay the premium in advance. So therefore, we know that that premium which you are paying basically covers or basically is an insurance cover for the next 1 year. For the next 1 year. So basically, much of the money collected by the insurance company or much of the revenue is received in advance. Now, this premium is only supposed to be recognized as an income by the insurance company once the period covered has expired. For example, if the insurance company has received premium of 1 billion, it covers the next 2 years. So that premium will only be deemed to have to be earned as an income once the 2 years are over, or basically 1 year is over. So therefore, you may see that out of these particular premiums which were received during the current year, you may be told that part of it was not yet earned because the period covered has not done what expired. So what do we do to this particular net premium? We basically add the unearned premium and earned premium balance brought down. So these are the premiums which were not yet earned in the previous year because the period covered was not expired. Automatically, the period covered by those premiums will expire during the current year because usually the premium you pay is for 1 year. So any premium which was not yet earned in the previous year because the period covered had not expired will be earned during this year. So therefore, these are the unearned premium from the previous year. And then to this we less the unearned premium, balance carried down. So these are basically the premiums which were received during the current year. These premiums which were received during the current year, but because the period covered has not expired, they have not yet been earned. So they should be deducted from this. And then out to this, we add something known as the commission on reinsurance, ceded. Also, I'll be able to explain something to do with that. I just put it as a note there. Yes, I'll be able to give a note for that. I'll also be able to give a note for that. So, and then we get the total here. We proceed and we lessen out the expenses. And the expenses which we less here are basically the expenses specifically relating to each insurance business because they are general expenses. The general expenses to the insurance company, we take them here to the general income statement. But basically what we record here and the specific expenses relating to each insurance business. For example, in this case, you may be given some legal costs associated with each insurance business. We may also be given budgets which were written off. Budgets written off, these are maybe the premiums which the customers decline to pay. We may also be given the management fee for each insurance business. We also have something called the net claims. In fact, this is basically the main expense for each insurance business. So once we have various individuals who have insured their subject matter with the insurance companies. So, and maybe the event insured against have occurred, they go to the insurance company, they use a claim. You have insured your car, you have taken a comprehensive insurance cover, your car is involved in an accident, you raise a claim with your insurance company. So once you are paid by insurance company, that is an expense relating to that insurance business. So we are going to look on how we compute this. We will have a note on that, note 3. Yes. So, and then also there is something else here we should not forget, known as commission on reinsurance accepted. Commission on reinsurance accepted. I'll also be able to give a note for that. What we mean by that? Yes. And basically we less all those particular expenses from our total revenue here, our total revenue there, and basically we get something called the net income. The net income from each insurance business. The net income is basically the profit from each insurance business. So this is basically how we prepare the revenue account for each insurance business. So I think before you look on how we prepare the general income statement, maybe I can just give explain some of these items. Like one, the net premium. So how do we compute the net premium? Which will be taken to the revenue account? So we can say this is basically computed by preparing premium account. Remember, premium is basically what you pay as a person who has taken an insurance cover. So to the insurance company, this is the amount they receive. They receive. So how do we prepare this account? The premium account. So, and also assuming our insurance business is providing to insurance business, is involved into insurance business, that is basically fire and the fire and life insurance. Fire and life, we have two columns on both the debit and the credit side, the fire and life insurance. So in most of the cases, you'll be told that some of the customers or some of the clients have not paid their premium. So if you have not paid your premium to an insurance company, you have not cleared your premium to the insurance company is an asset. So therefore, you'll be given the premiums outstanding at the start, which basically we record here as an asset. The premiums which were outstanding at the end of the year, simply because it's an asset. Premium which you have not paid is basically an asset. Then you will also be given the premiums which were received. So an insurance company can receive premium either from the client directly, from the stock brokers, and so on. So therefore, the premiums which were received, the double entry, we follow the double entry, is debited in the bank and then credited in this account. So the premium which was received. And this premium can be received either from the clients, from the insurance brokers, from the insurance brokers. Then on this side, still we have the reinsurance premiums which were received, reinsurance premiums which were received. On this side, we have the reinsurance premiums which were paid, reinsurance premiums which were paid. So this is basically whereby I hope you know what is basically to reinsure. So assuming we have a certain insurance company A, this insurance company A, which has got a number of clients, this particular client have insured a number of subject matter with it, but this insurance company may feel that the risk insured with it are too much. If maybe something happened, it may not be able to pay. So this insurance company may make a decision, can we reinsure some of this risk with another insurance company? So insurance company B, maybe something like that. So this insurance company will be paying something called the insurance premium. And then this one can receive reinsurance premium from another insurance company. So this reinsurance premium paid, the double entry, we debit this account, we credit back. And then from there, what we do, we basically balance this account. The balancing figure, which is on this side, is the net claims. The net claims. And the net claims is basically now what we recognize there. So that's basically how we compute the net premium, So then the other note we need to discuss here is on this one. The commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance. Oh, sorry. Sorry. This one should be net premium, not net claim. Thank you, Mike. Yes, so that one should be the net premium, not the net claims. Thank you for that. Yes. Now, in this case here, what is the commission on reinsurance ceded? So first of all, to cede ground is basically whereby you accept that as an insurance company, the risk insured with you are too much. If all the claims are reached by your customers, you'll not be able to pay them. So you have ceded the ground. So therefore, what you do, you reinsure those particular sum of the risk with another insurance company. Company. So assuming we have insurance company A, this company may feel that the risk insured with it are too much. So it decides to do what? To reinsure some of them with the insurance company B. It is obvious that this company here will pay something called the reinsurance premium. So this company A, will pay something called the reinsurance premium. So this particular reinsurance premium, we said to the insurance company A, they are reinsurance premiums which have been paid. It is obvious that this company here, that is insurance company A, is giving insurance company B some insurance business. It's then fair for this company to pay some commission. So if I give you some insurance business, you must give something in return, which is called a commission. So therefore, the commission which will be paid by this insurance company, and basically which is paid to our insurance company A, to this company we say it is a commission on reinsurance ceded. It's the commission on reinsurance ceded. To this insurance company is an income. So therefore, we can say this number one is an income. And number two, we can say it is computed. It is computed based on the reinsurance premiums which are paid. So the reason why it is important for you to note that is because in most of these particular questions, you'll be told that the commission on reinsurance ceded is 5%. 5% of which the examiner will not tell you. 5% of the reinsurance premiums which were paid. So if this company paid reinsurance premium of 2 million, there may be an agreement that this company will be paying a commission of 2%. So it should be 2% of the reinsurance premiums which were paid. Yes. So then from there, we can look on the other item here, the net claims. How do we compute the net claims? So the net claims, basically these ones are computed by preparing the claims account. The net claims. So in this case, we have to prepare the claims account. So remember, claims, this is what now the customers, the clients of the insurance company want to be paid. You have insured a certain subject matter, and maybe because the event insured against has occurred, you have reached a claim with the insurance company. So this one we have said to an insurance company is basically what is an expense. So equally in this case, we prepare this for each insurance business, assuming we have fire and we have rise. So in most of the cases, we'll be told, number one, there were some there were some claims which were not yet paid by the insurance company. So the premiums not yet paid by the insurance company, this is a liability. So being a liability, the claims outstanding being a liability, That one would be the opening balance with this account on the which side? On the credit side. So the claims outstanding at the start, the claims outstanding at the end. What else do we record in this particular account here? The other item which we record here are basically the claims which were paid. You'll also be given the claims which were paid. The claims which were paid. So the claims which were paid, basically the double entry for that is what? The double entry for that would be to debit this account with credit bank. That is basically the double entry for that. Then the other item you may be given is what? Are the expenses relating to the claims. Expenses relating to the claims. Expenses which relate to the claims. And basically the expenses relating to the claims, those ones, they should be debited here. Those ones should be debited in this account. What is the double entry for those expenses? Because they were paid, we credit them in the bank, we debit them here. And then from there we do what? We balance this account, and the balancing figure, which will be on this side, is basically now what we recognize as an expense, in the revenue account. In the revenue what? Account. In the revenue account. So that's basically how we compute the net claims. We compute the net claims. So the other item maybe I need to explain here, number 4, is the commission on reinsurance. On reinsurance accepted. The commission on reinsurance accepted. Commission on reinsurance accepted. So commission on reinsurance accepted. So when we talk about reinsurance accepted, this we are assuming we are preparing this financial statement for insurance company A. This insurance company here may have accepted to reinsure certain risk or to reinsure certain risk of a certain insurance company, assuming we have insurance company C, and this insurance company has reinsured some of the risk with our insurance company A. So we say that is reinsurance accepted. So this company here will pay to our insurance company something called the reinsurance premium. But basically to our insurance company here, this will be reinsurance premiums which were received. So to our insurance company A, that will be reinsurance premiums which were received. It is obvious that because our insurance company has been given some insurance business, it must pay a commission. So this is basically a commission which is paid to our insurance company. So once our insurance company pay a commission, automatically that is an expense. So this commission on reinsurance accepted, one, this is an expense. This is what is an expense. And number 2, this one is computed. Based on the reinsurance premiums, which were received. Because in an exam, what the examiner will tell you is that the commission on reinsurance accepted is maybe 2%, 5%, but he'll not tell you it is 2% or 5% of what. So it's basically upon you to do what? To know that this one is computed based on the reinsurance premiums which were received. So I think basically that's what you need to know as far as the preparation of the revenue account is concerned, specifically computation of net premium, net claims, the commission on reinsurance accepted, the commission on reinsurance what? Exceeded. Basically that's how we do what? How we compute those items. Then after preparing the revenue account, we have determined the performance of each insurance business. Then from there, we prepare a general income statement, or basically a general statement of what? Profit or loss. Now this one, as the name suggests, is basically prepared to do what? To determine the performance of the entire insurance business. This one is not prepared to determine the performance of each insurance business, but this one is prepared to do what? And to determine the performance of the entire insurance business. So we can say this is the prepared. This is the prepared to do what? To determine a performance for the insurance company. The performance of the insurance what? The performance of the insurance company. The performance of the insurance company. So how do we prepare this? Quite simple. Quite simple. We take all the incomes of the insurance company, and one income of the insurance company will be the net income which was generated from individual insurance business. So we take into account those incomes. We add them, the net income from individual insurance business. We add any other income by the insurance company, like an investment income and so on. And then we less now the general expenses. General expenses are those particular expenses not relating to the individual insurance business, not relating to fire, not relating to maybe life insurance. And then from there, insurance companies also prepare the statement of our financial position. So statement of financial position, we know this one is prepared to ascertain the financial position of an insurance company. We prepare this in the normal way. We take assets, which we classify into two, non-current and current. We record equity, and then the liabilities, and then the liabilities. So the preparation of this is just the same with the preparation of the statement of financial position for other insurance, for other companies, companies. So I want us to do a question, and basically we're going to borrow a question from 𝐉𝐎𝐈. So remember this topic previously it was in 𝐉𝐎𝐈, just like what I said in relation to the topic of banks. So this topic was previously examined in 𝐉𝐎𝐈, CP intermediate level, but basically it was taken to AFR, Advanced Financial Reporting. So we will definitely borrow a question from that, and I want someone to go to the link for. I know you have the link for the past papers. Someone to download and share this question. I don't know who will be in a position to do that very fast. You go to those links for past papers. I know you have them, and you download this paper from 𝐉𝐎𝐈. September 2021. September 2021. The question for 𝐉𝐎𝐈, and you share that in the class WhatsApp group. September 2021. The question I want us to do is basically question 4B. 4B. Yes. So someone maybe to download that paper and please share that in the class WhatsApp group. Share that in the class WhatsApp group. Share that in the class WhatsApp group. Yes, I'm waiting for someone to share that paper from 𝐉𝐎𝐈. From 𝐉𝐎𝐈. September 2021. September 2021. Yes, is someone able to do that? Has the question been reshared? I'm waiting for that, for someone to do that. To share that paper. To share that paper. Yes, have you been able to get that question? I'm saying if you just need to use those links, the link for past papers. I know you have those links for past papers, for downloading the past papers. You go to that question for September 2021. Question number, you just share the entire paper. Yes, I can see the question has already been shared there. I can see the question has already been shared there by Diana. Thank you, Diana. Thank you. Yes. Okay, so let's go to that question here. Let's go to that question. Let's go to that question here. September 2021. And basically this is the question 4B. Question 4B. 4B. So what are we told here? What are we told? The question reads, the following trial balance was extracted from the books of 𝐷𝐼 Insurance as at 31st of July 2021. So we're given a trial balance. We're given the premiums outstanding on 1st of August 2020. We are given the retained profit on 1st of August 2022. We have the share premium, ordinary share capital. We have investment income, account payable, management expenses relating to marine and fire. We have depreciation of non-current asset, direct asset remuneration, audit fee, freehold property, motor vehicle at net book value, equipment and computers net book value, furniture fittings net book value, financial assets, budget written off for marine for fire. We have the survey expenses on claims, equally for marine and for fire. We have the legal cost for marine fire, claims paid marine fire, claims outstanding for marine and fire, and an expired premium for marine and fire. We have the cash and bank balance, account receivable, direct premiums which were received, reinsurance premiums which were received, reinsurance premiums which were paid, and then we are given additional information about your total premiums of premiums outstanding. As at 31st of July 2021 amounted to 14.4 and 6.4 for marine and fire, respectively. 2, the reserve for unexpired premium must be maintained at 100% and 50% of the net premium for marine and for fire insurance, respectively. 3, claims initiated and outstanding at the end of the year amounted to 7.2 for marine and 4.608 million for fire. 4, commission for both reinsurance ceded and reinsurance accepted is 5% of the premium. Number 5, provisions is to be made for the following: taxation, 4,152,000, ordinary dividends 5%, depreciation of motor vehicle 4.1, equipment and computer 2.16, furniture and fittings 2.4. What are we required to do? We are required to prepare the marine and insurance revenue account for the year which ended 31st of July 2021. Roman 2, statement of comprehensive income for the year which ended 31st of July 2021. And Roman 3, we are required to prepare the statement of financial position as at 31st of July 2021. So we will start with what is required in Roman 1, with what is required in Roman 1. And basically, we are required to prepare the marine and fire insurance revenue accounts. So let's start with that. We start with that. Basically, here we will have the revenue accounts, and basically in this case, remember you have said that this account is prepared using a T format. Not T format, but rather a vertical format. A vertical format. So here we will have our two insurance businesses, and that is marine and fire. I hope you can also be able to see that the figures we are given there are in thousands of shillings. So what we start by recording here are the revenue, or basically the incomes, the revenue. Now remember, we have said that the first revenue which we start with is basically the net premium. So net premium automatically, this one is not given. We will have a working as far as that is concerned. And then to this, we have said we add the unearned premium at the start of the year. Now, these premiums which were not yet earned at the start of the year, they can also be known as the unexpired premium. Unexpired premium. So because in our question here, we're not given an unearned premium, we're given something called the unexpired premium. Unexpired premium, these are premiums whose period has not expired. So we have said to this, we add the unearned premium. In our case, that one is known as the unexpired premium. Premium, basically at the start. That one should be added. And then to this, we less the unexpired premium. The unexpired premium at the end of the year. I think, first of all, we can record this one because it's given in the trial balance. I don't know whether you can see the unexpired premium at the start. That one is within the trial balance. In the trial balance, we are given the unexpired premium at the start. Can you see that? Somewhere down there. So the unexpired premium at the start for the first insurance business was 46,080. And for the other insurance business, this one was 24,000. I hope you can see those figures. So automatically, this one is not given. But we're given some information in relation to that in note number 2. Can you go to note number 2? In note number 2, we are told the reserve for an expired premium must be maintained at 100% and 50% of the net premium for marine and fire insurance business, respectively. So this one will have to be computed. And actually, we are told for marine will be 100% of the net premium. We have not yet computed the net premium. And this one will be 50% of the net worth premium. We need to compute the net worth premium. And basically to this, we have said, then we need to proceed. And basically we do what? We also include the commission on reinsurance ceded. The commission on reinsurance ceded. So I think maybe first of all, we can work out these items. We start by computing the net premium. The net premium. So for us to compute this, we need to prepare the premium account. We need to prepare the premium account. So let's prepare the premium account. The premium account, we will have the premium account for marine and basically for fire. The same case on the credit side for marine and also for what? For fire. Remember that is the credit side. This is the debit what? This is the debit side. So what do we record here? Or first of all, what do we record here? We start by recording the premiums which were outstanding at the start and also at the end. If you go back to the trial balance, you'll be able to see we are given the premiums which were outstanding. I don't know whether you can be able to see that. The premiums which were outstanding. The premiums which were outstanding. Are we given the premiums which were outstanding here? Because I can see that at the end of the year, in note number 1, we're given the premiums which were outstanding at the end of the year, which is basically note number 1. In the trial balance, we have premiums which were outstanding at the start, unexpired, the claims, legal, the burden. Yes. Actually, that is the first item in the trial balance. And in that case, you have seen that the premiums which were outstanding, this one is basically an asset. That's why you can see that trial balance, it is on the debit side. That is an asset. So these are premiums not yet paid by the client, not yet paid by the customers. So it's an asset. It takes what? 40 and basically 67 what? 20. And then we record the premiums which were outstanding at the end. This is from note 1. From note 1, additional information number 1, which is 14,400 and basically 64 and 64. So that is basically what we have. What else do we record here? If you go back to the trial balance, especially down there in the trial balance, you'll be able to see some premiums which were, first of all, the premiums which were paid. The premiums which were paid, those ones should be, that is the reinsurance premium paid. Those ones should be debited here. That's why you can see even in the trial balance, they are on the debit side. They should be recording this account to the debit side. So for marine, 76.80, for fire, 48. Then up there, I hope you can see we are given reinsurance premium receipt. Reinsurance premium receipt, you can see in the trial balance, it is on the credit side. The same case here. The reinsurance premium received. So for marine is 11,520. For fire is 76.80. Then equally above that, we have direct premiums which were received. So direct premium received, this one should also be credited here. Direct premiums which were received, that is 43,200 and 33,600. So we have dealt with those particular premiums. Anything we record in this account? No. So what we need to do then is basically we balance this account. The balancing figure, which is basically on this side, is the net worth, is the net premium. Is the net worth, the net premium. So let's do that. So we start by marine. We start by getting the net premium for marine. For marine, what are you getting? So we take what we have on the credit. Minus what you have on the debit. What are you getting? 52,800. 52,800. We do the same for fire. For fire, 76.80. Yes, what are you getting? Yes, yes. 36. One what? 160. 36, 160. Yes, so that's basically what we bring here. The net premium for marine is 52,800, and for fire is 36, 160. 36, 160. So that is basically how we compute the net worth premium. So having done, then we can proceed and we compute this. The premium not yet earned at the end of the year, the unearned premium, the unexpired premium at the end of the year. So we are given information in relation to that in note number 2. We are told that reserve for unexpired premium should be maintained as 100% and 50% of the net premium for marine and for fire, respectively. So the unexpired premium at the end of the year for marine will basically be 100% of this, 100% of the net premium. So 100% of that is 15,800. And this one should be maintained as 50% of that. 15% is what? 18 what? 080. 18,080. 18,080. That is basically what we have there. Yes. So next, let's move and we compute this. The commission on reinsurance ceded. We have said this whereby the insurance company will feel that the risk insured with it are too much. It decides to insure with another insurance company. It gives an insurance business to another insurance company. Our insurance company here gets a commission. So we have said this commission is always computed based on what? The reinsurance premiums which were paid. The reinsurance premiums which were paid. So that information we have it in note number 4. We are told commission on both the reinsurance ceded and reinsurance accepted is at the rate of 5%. At the rate of 5%. So this one will be at the rate of 5% of the reinsurance premiums which were paid. The reinsurance premiums which were paid, we have them here. We have them there. So we get 5%. 5% in each case there. 5% times 7680, which will give us 384. I hope that is what you're getting. For the other insurance, for fire, we get 5% of 48. And we get what? Is it 240? 240. Yes, 240. Yes, and I think now we are basically done here. We are done. So what we need to do, can we get the total revenue for each insurance business? The total revenue for each insurance business. So this one will basically be simple. This plus this. This plus this. That's the case? Yes. 46, 464. 46, 464. What about the other insurance business? 36, 160 plus 24,000 minus 18,080 plus 240. 42, very good, 320. So that is the total revenue. So to this, then we less what? We less the expenses. We less the expenses. So the expenses specifically relating to fire, specifically relating to what? To marine. So I think here we have said we need to have a number of expenses, starting with the net claims. We will have a working for this. That should be working 2. The other one is commission on reinsurance, basically accepted. And then from there, if we go back to the trial balance, we need to check now the specific expenses relating to, I think before we do that, can we first of all compute this? Because I think the computation of this is quite straightforward, even before you prepare the claims account. So let's first of all compute this one. The commission on insurance accepted. We have said this is a commission which will be computed as a percentage of reinsurance premiums which were received. What basically we have here. And it should be 5% of that. Should be 5% of that. 5% of 11,520. I hope that is a figure I'm given by Gilbert there. Yes, so that one would be 576. 576. What about the other insurance company? The other insurance business? It will be what? 384. 384. 384. I hope that is what you're getting. Okay. Yes. So then I want us to go to the trial balance. Before we compute the net claims, there are a number of specific expenses relating to each insurance business. We just first of all pick those expenses. So I think up there, I can be able to see we have management expenses. Can you see management expenses? And management expenses specifically related to marine and fire. So we first of all record that management expenses for marine 6240, and basically for fire 55.68. So then we also have some expenses there, but they are general, right? Depreciation, like directors' remuneration, audit, those are general. They go to the income statement. Then down there, you can see we have budget written off, budgets which were written off for marine is 11, sorry, that is 1632. For fire is 1152. Then we have survey expenses on cranes. So these are expenses relating to cranes. So any expense relating to cranes, that one is captured when preparing the claims account. Is not recorded here as an expense for individual insurance business. So that one will go to the claims account. Below that, we have the legal cost. The legal cost for marine for fire. Is it 1728 and 1248? I hope that is those are the figures. I hope those are the figures. And then from there, we have the claims. So automatically, this will go to the claim account. The other one is the claim outstanding that will go to the claims account. I think downstairs we have an expired premium. We have used that. Yes, I think what we need to do, I can't see any other expense relating to individual insurance business. Do we have any other? Do we have any other? I can't see any other. So let's prepare the claims account. The claims account, so that we compute the amount of net claims. So that we compute the amount of net claims. Net claims. Net claims. We compute the amount of net claims. So we prepare this for marine, basically for fire, marine, and also what? And also fire. So what do we record here? This kind of number of items. We will start with the claims which were outstanding at the start of the year, which is part of the trial balance. Down there, the claims which were outstanding. The claims outstanding, these are claims not yet paid by our insurance company. So the insurance company is a liability. So being a liability, it will be the opening balance in this account on the credit side. On the credit side. So the claims outstanding at the start for marine, 7680. For fire, 5184. And then down here, we need to record the claims at the end of the year. The claims at the end of the year. So the claims at the end of the year, this one we have it. These are the claims outstanding at the end of the year, given in note number 3. The claims initiated and basically outstanding at the end of the year was 72 for marine, and 4608 for what? For fire. For fire. What else do we record here? We go back to the trial balance. We have claims which were paid. Claims which were paid, I said the double entry for that is to debit this account with credit bank. So we have 23,712, and for fire is 17,280. The claims which were paid. What else do we record here? Any expense relating to the claim. So below those claims which were paid, actually above the claims which were paid, we have the survey expenses on claims. Survey expenses on claims. Those are basically expenses relating to who? To these particular claims. To these claims here. So we have 1845. And basically we have what? We have 1227. 1227. So we have dealt with those survey expenses, the claims which were paid. Yes. So I think now we are done. What we need to do is we balance our account, and the balancing figure on this side are the net claims, which we are going to recognize here as an expense. So let's start by computing the net claims for the first insurance business. I'm given those figures, you just need to confirm them. You just need to confirm those figures. Just confirm whether those figures are correct. Are those figures correct? Are those figures correct? Yes, yes, they are confirmed. So let's have those figures here. So we have 25,077, and then we have 1793, 1793. Is there anything which we have not dealt with? I don't think so. I don't think so. So I think we can then get the net revenue or the net income, that is. Let's get the net income. The net income of each insurance business. Yes, so those are the figures I'm given. Just confirm whether they are correct. Just confirm whether those figures are correct. Are the figures correct? 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 Yes, yes. So confirmed. Okay, that is already confirmed. So I think now we can proceed. We can proceed here. Yes, so let's proceed. And basically we do what? We prepare what's required basically in part B of that question. That is Roman 2. Roman 2. We are required to prepare the statement of what? Of comprehensive income. Statement of comprehensive income. Comprehensive income. So which is for the year which ended 31st of July 2021. 31st of July 2021. Remember, this one we have said is basically prepared to do what? To ascertain the performance of the entire insurance business. Sorry, not the insurance business, but the performance of the entire insurance company, because this one is basically prepared to ascertain the performance of each insurance business. So this is how each insurance business performs. This is basically the net income of each insurance business. So this one we prepare it to determine the performance of the entire insurance company. So how do we prepare this one? We start by recording incomes of the insurance company. So in this case, we need to have two columns here. We need to have two columns here. Like that, we will start with the incomes. And always the incomes we start with here is the net income which was generated from each insurance business. So this net income which was generated from each insurance business. So the net income generated from marine insurance business is basically 11,211. The one which was generated from fire insurance business is 16,037. So what we need to do to this is basically we add other incomes. Were there other incomes which were generated by this insurance company? Was there any other income? So for us to be able to check whether we have any other income, we go back to the trial balance. We know that all incomes, they have a credit balance. So we check the items appearing on the credit side of the trial balance. So up there, I can see retained earnings, share premium, ordinary share capital. Those are items of equity, but I can also see investment income. That is basically part of the other incomes, which is basically an amount of what? An amount of 20 688. So down there we have account payable, that is basically a liability. Then I'll go down there because I'm only interested with the items appearing on the credit side. So down there you can see we have claims, outstanding and expired premium. We have dealt with all those. And then down there you can see we have premiums which were received, we have dealt with all those. So in our case, automatically here we don't have any other income. We don't have any other income. So what we need to do is we get the total incomes of this insurance company. 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 Total incomes of this insurance company. Total incomes of this insurance company. And I'm given a figure of 29,936. Confirm whether that is what you're getting. Yes, that is confirmed by Rich Motser. Okay. So to this, then we proceed, and now we less what? We less the expenses. We less the expenses. Remember, the expenses which we less here are the general expenses. General expenses are those expenses which do not relate to marine and also what? Fire. They are general expenses of the company. They are not expenses of these insurance businesses. So in the trial balance, I think we have this kind of number of them. Maybe remember all expenses, they have a debit balance in the trial balance. They then have a debit balance in the trial balance. So starting from there where we have management expenses, remember that was a specific expense. Down there, you can see we have depreciation. Depreciation on non-current assets. Depreciation on non-current assets. So, but in this case, here the examiner tried to trick you. So I hope you can see that depreciation. And also, if you go to note number 6, we are given the breakdown of that depreciation because whatever you're given in the trial balance has to be the total. So can you add the depreciations in note number 6 and you confirm whether it is coming to this amount here? Whether it is coming to 86, 88. The depreciation which is in note number 6. Is it coming to the figure we have there? Yes. Yes. So, but I will tell you why the information in note number 6 was given. That was just an examiner trying to trick you and explaining that maybe we're preparing the statement of financial position. So below the depreciation, we have directors' remuneration. This is still an expense to the company. Directors' remuneration is an expense, which is an amount of 4752. So below that, we have audit fee. Audit fees is basically also an expense, 2304. So we have freehold property, we have motor vehicle, we have equipment, we have furniture, financial assets, all those are assets. And then I think we have dealt with all those the items, most of the items which are down there, including budget, survey, legal, claims outstanding and expired premium. We have dealt with all those. But cash and bank balance, that is an asset. And then account payable is an asset. Do we have any other expense? In the additional information, number 1, you have dealt with that. Number 2, number 3, number 4. Yes, I think we don't have any other general expense. Or we have any other general expense? I can't see any. I can't see any. I can't see any. I can't see any. So we need to get the total general expenses. We take them to the last column. We take them to the last column, and basically we deduct them from the total incomes. We deduct that from our total income. So first of all, confirm whether you're getting such a figure. Huh? Are you getting? Is that what you're getting? Is the total expenses? 15,744. Yes, yes. So we less that from our total incomes, and because this is a company, we will get the profit before tax. We will get the profit before tax. So how much is the profit before tax? 14,192. 14,192. 14,192. So because this is a company, we must compute the tax. We are given some information in relation to that in note number 5. Provision are to be made for the following. So we are told a provision will be made for tax. So we are given the tax. So we left that here, which is an amount of 4152. 4152. So then we get the profit for the year. the profit for the year. The profit for the year would be 10, 0 what? 10, 0, 40, 10, 0, 40. 10, 0, 40, is that the profit for the year? 10, 0, 40. 10, 0, 40. Please confirm whether you're getting the same figure. So this minus that, yes. So then also in note number 4, we are told this company was to provide for dividends. Dividends we know are payable from the profit. So to this, we will also less the proposed dividends, because those dividends were not paid, they were just proposed. Proposed dividends. So the dividends were, we are told, will be 5%. We are told it will be 5 what? %. So 5% of what? This one should be 5% of the ordinary share capital. 5% of the ordinary share capital. The ordinary share capital is 28,800. 28,800. 28,800. 28,800 should be 5% of the share capital. And that is giving us an amount of how much? That is giving us an amount of how much? Yes, it's giving us an amount of 1440. Then what we get down here is the retained profit. The retained profit for the year. So the retained profit for the year. The retained profit for the year, this one will be 86. Will be 86. So having that, then finally, we need to add the retained profit, or in other terms, the retained earnings, balance brought down. So these are retained profit or the retained earnings at the start of the year, and that is the figure we have in the trial balance. If you go to the trial balance, like 1 hour 30 minutes, or maybe 1 hour 20 minutes, to be able to watch some of those particular small topics. So I want us to look on this topic, financial instrument, and basically I've said this is something you covered in financial reporting and analysis. So the first thing we need to ask ourselves here, what are financial instruments? Financial instruments generally, this refers to the various securities which are issued by the company whenever the company wants to raise capital. Like then what we know is that even, yes, so this should be our topic, or basically for the issue of debentures, this is what we refer as a financial instrument. This is what we refer as a financial instrument, because we are saying this particular contract will give rise to a financial asset to one of the company. Will be able to explain more on that, and also give rise to a financial liability or equity to the other to the other company. Like generally, what we know is that if this company has issued ordinary shares, if this company issue ordinary shares, basically this company raises a capital which is known as ordinary share capital. If company X has issued ordinary shares, it will raise a share capital which is known as ordinary share capital. And basically what we know is that this ordinary share capital is basically part of equity, because we know equity comprises of share capital and reserves, So therefore, if this company has issued ordinary shares, maybe to company Y, you can see that this particular contract which this company will enter into, it will basically give rise to equity, because that company has raised ordinary share capital, which is part of equity. On the other hand, we are saying this company can raise capital by issuing debentures, or basically issuing both. So let's assume that this company here has issued debentures. Now, generally, what we know is that once a company has issued debentures, that company has an obligation to pay interest. And once those particular debentures mature, the company has to redeem them back by paying back the principal amount. So meaning that once a company has issued debentures, the company has a financial obligation to pay interest. And once the debentures mature, the company has to redeem them by paying back the principal amount. So this financial obligation to pay interest, to pay the principal amount, this is a form of a liability, and specifically this is known as a financial liability. So therefore, if you're told a company issued debentures, issued both, then that is a form of a financial liability. So therefore, this company, you can see, once it has issued debentures, then that will give rise to a financial liability, as far as that company is concerned. We have said if this company issue ordinary shares, our company will raise ordinary share capital, and basically that gives rise to equity. And then in this case, equally, we assume that these shares are basically debentures issued by company Y. Some of them have been issued to company X. Some of them have been issued to company X. So once this company buys shares, because this company will be buying, this company will be buying, this company will be investing in shares, will be investing in debentures issued by company X. So if you invest in shares, if you invest in debentures, to you, that investment is an asset. To you, that investment is what? Is an asset. And specifically, an investment in shares or an investment in debentures, including treasury bills, treasury bonds issued by the government, that asset, we refer to it as a financial asset. We refer to it as a financial asset. Remember from what you did in financial accounting, financial reporting, there are different types of assets. We have property, plant, and equipment, which are tangible and current assets. We have intangible assets, and we also have financial assets. Financial asset is an investment in shares or an investment in debentures. So our company here, company Y, will invest in shares or debentures issued by company X. So therefore, to this company, that is a financial asset. It's a financial asset. So therefore, you can see in this particular contract, which is entered into between two companies, company X and company Y, it basically gives rise to a financial asset to this company, equity or financial liability as far as this company is concerned. So that's why we are saying a financial instrument is a contract which gives rise to financial asset, one of the company, a financial liability or equity to another a company. That's why in our introduction we said financial instruments are those securities, including shares, including debentures, which are issued by the company to raise a capital. Now, in this topic here, generally, we're going to look on how we do how we account for the financial assets, the financial liabilities, and also the classification, because we have different classification of financial assets, different classification of the financial liabilities. But even before you do that, next I want us to look on something called the recognition of financial instrument. Recognition of financial instrument. What do we mean by recognizing financial instrument? Recognizing, in very simple terms, is basically the process of recording something like an asset or recording something like a liability in the company's books of account. So a question arises here. If this company issues shares or issue debentures, or maybe this company purchase shares or debentures, so when should these companies go ahead and recognize, or in other terms, record those particular shares or debentures in their books of account? According to IFRS 9, this standard here, financial instrument, whether issued or basically whether purchased, should be recognized once an entity becomes a party to the contractual relationship. What does that mean? It basically means that once this company has issued these particular shares or debentures, even if our company has not been paid for the shares, has not received cash for the shares or debentures which have been issued, our company has already become a party to that contract simply because it has already issued the shares or debentures. The same case, once this company purchased the shares or debentures issued by this company, even if this company has not paid for those shares or debentures, this company should go ahead and recognize that in its books of account as a financial asset. So therefore, according to IFRS 9, a financial instrument should be recognized in the company's books of account whenever an entity becomes a party to the contractual relationship. Then next, I want us to discuss something to do with the recognition of financial instrument. The recognition basically is the direct opposite of recognizing. The recognition is the direct opposite of what? Recognizing. The recognition of a financial instrument. So by definition, we say to be recognized is to remove a financial instrument from the entity's statement of financial position. It is a process of removing financial instrument. If, for example, a company had issued debentures, so those debentures may be removed from the balance sheet, may be removed from the statement of financial position, maybe because they have been redeemed. So that process through which financial instruments are removed from the statement of financial position, we refer to that as the recognition. So this is the removal. This is the removal of previously recognized financial instruments from entities statement of financial position. A company had issued debentures, but now those particular debentures have been removed from the statement of financial position. They will no longer be shown there as a liability. That process we refer to it as the recognition. Now, when can the financial instrument be recognized? We have various criteria upon which the financial liabilities can be recognized, of which in this case we are going to look on the recognition criteria for both the financial assets and also the financial liabilities. But even before we look on the criteria here, you have to recall what is a financial asset. A financial asset, basically, I've said that this is an investment in a debt instrument, investment in debt instrument. For example, if today you have some cash in your bank, instead of money staying there, you may decide to invest in government securities. You go to you buy government securities having a value of 1 million, and then you'll be earning some interest. Once they mature, you're given back your money. So that investment in government securities to you is a financial asset. Sasa? Yes. So a question then arises: when should the company remove financial asset from its books of accounts? There are two criteria when that may happen. One is when the entity transfers the rewards and the risks associated with the financial asset. When the entity transfers the risks and the rewards associated with the financial asset. What does that mean? And let's assume that we have a company here, company X, and this company has invested, for example, in the debentures of another company. So to this company, we are saying that investment in debentures is a financial asset. So when should this company, or when can this company remove those financial assets from its statement of financial position? One of the circumstances when this company transfers the risk and reward. So generally, what we know, anytime you have undertaken an investment, anytime you have invested, there are some rewards, there are some risks associated with that particular investment. But when can you transfer those rewards and risks? So to transfer is basically when you sell. So meaning that once this company sells these particular debentures, then we say that the company has transferred the risk and rewards. It is obvious that once you have sold an asset, you cannot continue showing it in your balance sheet because it has already been sold. You have transferred the risk and rewards. They recognize that, remove that asset from your balance sheet. Number two is when the entity's right to receive cash expires. When the entity's right to receive cash has done has expired. So the entity's right to receive cash has expired. So generally what we know is that once you have invested, for example, you have invested in treasury bonds having a life of 2 years, it basically means that you have a right to earn interest from the government for the next 2 years. At the end of the second year, once those treasury bonds mature, you'll be given back the principal amount you invested. So meaning at the end of the second year, your right to receive cash will come to an end simply because those particular treasury bonds have been redeemed. They have matured and the government has done has redeemed them, and you have been given back your principal amount. So if you are a company and basically you had shown that as an asset, you cannot continue then showing that as an asset simply because your right to receive cash has expired. You have earned interest for the next 2 years, and then at the end of the second, you have been given back your principal amount. Then there is no way you will continue showing that as an asset in the statement of financial position. So therefore, the other criteria for recognizing financial asset is when the entity's right to receive cash has expired, maybe because the debt instrument which the company had invested in have matured and they have been redeemed. So in this case, we have those two criteria. Those as the two criteria upon which a financial asset may be recognized. And in this case, we have said it's important for you to understand what is a financial asset. It's basically an investment in shares. It is an investment in debt securities. At a later stage, we are going to look on the various categories, the various ways in terms of how we classify the financial asset. But next, I want us to look on the criteria or the criteria for recognizing a financial liability. Financial liability. What is a financial liability? A financial liability basically here is we say is an obligation to pay cash. An obligation to pay cash generally arises whereby a company has issued debt securities. Like assuming we have company X, that company has issued debentures, that company has issued bonds, maybe having a life of 2 years. So that company has an obligation to pay interest for the next 2 years. And once those debentures or bonds mature, the company must redeem them by paying back the principal amount. So therefore, a financial liability here, this is a financial obligation to pay cash. Financial obligation to pay cash. And basically, this arises whereby a company has issued some debt instrument. Debt instrument issued by the company is a financial liability. So when should the financial liabilities be recognized or removed from the statement of financial position? Here we have just one criteria, and that is when the entity's when the entity's obligation to pay cash expires. When the entity's obligation to pay cash has done what? Has expired. What does that mean? It basically means that, or assuming you have a company here, company X, this company has issued debentures, and these debentures have a life of 3 years. Having a life of 3 years means that this, or in this case, this company will be required to pay interest at the end of year 1, at the end of year 2, and also at the end of year 3. And then at the end of year 3 here, these particular debentures will be redeemed, and the company will pay back the principal amount. So once the company pay back the principal amount, then we say that the obligation of this company to pay cash will expire at the end of year 3. So it is obvious that because those particular debentures have been redeemed, the company cannot continue showing them in the balance sheet as a liability. They have already been redeemed. So in that case, then we say that those debentures, those financial liabilities have been what? Have been recognized. They have been removed from the entity's statement of financial position because the obligation of the entity to pay cash has done what? Has expired. Expired. Yes. So that, or those are basically the various criteria upon which financial assets and financial liabilities may be recognized. So you may come across a direct question asking about this, whereby you're required to explain the criteria for the recognition of financial assets and financial liability. So next, I want us to look on something known as the compound financial instrument. So compound financial instrument, these ones are abbreviated as CFI. So what do you mean by compound financial instrument? So these are the financial instruments, things like debentures, things like bonds, which contains both equity and liability component. So therefore, these are financial instruments, which contains both equity. They contain both equity and liability component. They contain both equity and the liability component. Now, what is a good example of this? What is a good example of a compound financial instrument which contains both equity and liability component? Examples of this Examples of these include the convertible securities. The convertible securities. So what do you mean by convertible securities? These are the securities which can be converted, or basically these are security where the holders have the right to convert them into ordinary shares. The holders have the right to convert them into ordinary shares. And actually, good examples of these convertible securities include the convertible debentures, the convertible bonds, maybe the convertible loan stock, And why do we refer to these securities as convertible? Why do we refer to them as convertible? Is because the holders of these securities can be able to convert them into ordinary shares. I hope you can be able to remember in company law. In the topic of the debt instrument, you talked about different types of debentures, and you're told that one type of debenture which may be issued by the company is convertible debentures. These are debentures which you can be able to convert into ordinary shares of the company. So therefore, anytime you come across a debt instrument, like debentures, like bonds, like loan stock, which are convertible, then we say that they are compound financial instruments. They contain both equity and liability component. Now, why do we say that these compound financial instruments or these convertible securities contain equity and liability components? Two reasons. One, the company which issue these securities, one, we say the issuer is basically the company which has issued. The issuer, the company which has issued these convertible securities, has an obligation to pay cash. What does that mean? It basically means that assuming company X has issued convertible debentures, then we are saying that this company has an obligation to pay cash. The cash to be paid by this company is interest and the principal amount. If the holders of these debentures will not convert them into ordinary shares, once they mature, our company will be required to do what? We will be required to redeem them by paying back the principal amount. So the issuer, the company which has issued those debentures, has an obligation to pay cash. This obligation to pay cash to accompany this is a liability. This obligation to pay cash to the company is what? Is a liability. This financial obligation to pay cash is a liability. If you have taken a loan from a bank, basically you have to repay back that loan. To you, that is a liability. If a company has issued debentures, our company has to pay interest, and once the debentures mature, the company has to pay back the principal amount. That is a liability to our company. So that's why we are saying that these convertible debentures, they have liability component. The company which has issued them has to pay cash. Number two, we say that the holders of these compound financial obligation, the holder has a right to convert them into ordinary shares. So basically, if you hold some convertible debentures, you can be able to convert them into ordinary shares of the company. What does that mean? It basically means that you have a right to receive ordinary shares of the company. Naturally, that right to receive the ordinary shares of the company, that one we refer to it as equity, because equity is whereby you have already bought the shares of the company, or you have the right to buy those shares. You have the right to be issued those shares. We are saying you hold convertible debentures which you can be able to convert into ordinary shares. So that right you have to convert those securities into ordinary shares is called what? Equity. So this why we say that all convertible securities contain equity and liability component. We have said they contain a liability component simply because the company which has issued them has an obligation to pay cash. The cash to be paid here, we have said, will be in form of interest. The cash to be paid here will be in form of interest and the principal amount. Number two, we have said they contain equity components simply because the holder of those convertible securities can convert them into ordinary shares, has the right to convert them into ordinary shares, which basically we are saying is what is an equity in itself. Now, this compound financial instrument should be accounted for in accordance with a different standard, not IFRS 9, but they should be accounted for in accordance with International Accounting Standard number 32. This standard, IAS 32, basically requires that anytime a company has issued compound financial instrument, the company should split these two components. The company should split the equity component and the liability component and account for them separately. So therefore, this standard, we say IAS 32 requires an entity to split. An entity to split the two components. To split the two what? The two component. So which are the two components here? The equity component and number two, the liability component. So those two components must be separated, must be splitted in other terms and be accounted for separately. I want us to look on how basically we do that particular split. We do that split, but even before you do that, you can confirm whether we are together up to that point. I hope you're together up to that point. Are we together up to that point? Maureen, Kennedy, Ismail, Wanyama, are we together up to that point? I hope you're getting the video from your end clearly. I hope you're getting, my sound is perfect. My sound is okay from your side. Okay, sawa. Let's continue then. If you're together up to that point, we can proceed. Now, what I've said is that this particular standard, IAS 32, requires that anytime the company has issued securities which are convertible debentures, convertible bonds, convertible on stock, which contains equity and liability component, the company should split the equity and the liability component. How should that split be done? So we have two steps to be followed. The step number one is that the company should compute the liability component. Step one, for us to basically compute the liability component. So in this case, if you can be able to recall, we have said this liability component analysis as a result of the company's obligation to pay cash, which is in form of interest, which is in form of principal amount. Like assuming in this case, a company has issued debentures having a life of 3 years, year 1, year 2, year 3. So a company has issued convertible debentures having a life of 3 years, year 1, year 2, year 3. So in this case, we have said at the end of year 1, at the end of year 2, at the end of year 3, our company will be required will pay the principal amount, and also at the end of year 3, the company will be required to pay. I've said at the end of year 1, at the end of year 2, at the end of year 3, the company will be required to pay the annual interest. And then once they mature, that is at the end of year 3, the company will be required to pay back the principal amount. But in this case, here we assume that the holders of this particular convertible debentures will not convert them into ordinary shares. Shares. So if the holders will not convert them into ordinary shares, for the next 3 years, the company must pay interest on annual basis, and at the end of the third year, the company must do what? Must redeem them by paying back the principal amount. So how do we therefore compute the liability component? To compute the liability component, which has to be computed on the date of the issue here, we compute that by discounting all this. To discount basically entails computing the present value. So we get the present value of the interest to be paid annually and the present value of the principal amount. So meaning that the liability component, and basically this liability component is computed on the date of the issue. Or in other terms, this split should be done on the date of the issue. The date they were issued, if they were issued 1st January 2023, that is when we split the two components. Sasa? Yes. So to compute this liability component, the liability component here is equal to the present value the present value of the annual interest So basically, I hope you know how to discount this. Remember, these are annuities, this, and this, because these are similar cash flows. So these are annuities. So you know how to discount that from financial management. And then to this, we add the present value of the principal amount. The principal amount is this amount, which is payable upon redemption. So basically, we do what? We add these two figures: present value of annual interest plus the present value of the principal amount. That is how we compute the liability component on the date of the issue. After computing the liability component, step number 2, we proceed and we compute the equity component. Step 2, compute the equity component. So how do we compute the equity component? To compute this equity component, we take the total proceeds. So basically, in this case, when we talk about the total proceeds, this refers to the amount of money which was received by the company after issuing these convertible debentures. So how much amount was received? This, in other terms, is known as amount received. The amount received, or in other terms, the total proceeds. So total proceeds, and then to this we less the liability component. Which you have computed in step number 1, which you have computed here in step 1, which you have computed there in step 1. I hope you can be able to see down there. Yes, which you have computed in step 1. Step number 1. Yes, so computed in step number 1. So after deducting that, we get the difference here. And this difference is the equity component. It's also important for me to mention that the value for this equity component, basically this one remains constant. The value for equity component, which has been computed on the date of the issue, will remain the same in year 1, year 2, year 3. So that remains constant. The value for equity component does not change. But this value for the liability component, which I have computed in step 1, remember this represents what the company will pay in year 1, year 2, year 3, year 4. So take into account this like a loan. If, for example, today you go to a bank, you take a loan for 5 years. So that means that for the next 5 years, you have an obligation to pay back that loan. So, and basically what that means that generally you should prepare something, or a bank prepare something called a loan amortization schedule to gradually write off that loan, such that at the end of the 5th year, the value for the loan will be 0. The same case, this liability component, we amortize it. This liability component, we do what? We amortize it. To amortize a liability or even amortizing an asset, this is the process of gradually writing off. Gradually writing off an asset, gradually writing off a liability over a given period of time. So therefore, these are basically the 2 steps which we follow to do what? To split the equity component and the liability component. The equity component and the liability component, equity component and the liability component of a compound financial instrument, instrument. I think with that particular knowledge, we can go to the past papers. I want us to do a question from the past papers. And maybe for those who are coming from CPA intermediate level, there was a question which was examined on this in FRA, and maybe if you are in my class, automatically we did that question. So I want us to do another question, basically from AFR. So someone is asking here, how do we get the amount received? Total proceeds. Total proceeds always will be told how the debentures. For example, in this case, you can be told the company issued debentures having a par value of 100 million, having a par value of 100 million at a discount of 10%. At a discount of 10%. In this case, to compute the amount received is quite simple. The debentures issued had a value of 100 million, but you can see they were issued at a discount of 10. Did our company receive the full amount of 100 million? Yes or no? Did the company receive an amount of 100 million? No. The amount received in this case would be 90% of 100 million. So the amount received in this case is computed always based on the information which is provided. So the examiner will give you information which basically will assist you in terms of computing the amount which was received. So I want someone to share the past papers in the class WhatsApp group. Someone to share the past papers in the class WhatsApp group so that I can tell you the question I want us to do. The question on compound financial instruments. Yes, I hope those past papers have been shared there in the class WhatsApp group. Yes, I can see they have been shared there by Ismail. So the question I want us to do was, I think, tested some time back, not too back. Let me see. Yes, there was a question from this topic, though it is not in relation to compound financial instrument. This was just a small question. I think it was in the sitting of 2021 here. A question for Naivasha Company Limited. Just a small question. I'm trying to retrieve that question here. Yes, so it is a question from May 2021. May of 2021. And this is question number 4B. Question 4B. So let's go to this particular question here. 4B, May 2021, question 4B. So once you get the question, just confirm that you have the question with you. So once you get the question, just confirm. Okay, confirmed by Otunga there. Yes, Ismail Aither Mase has confirmed Maureen, are you there? Diana, you have the question with you. Eddie, Faith, Patrice, Samuel, you have the question with you. Do you have the question with you? Yes. Yes. So what are we told here? What are we told? What are we told? Just a small question, but you can see the question had 6 marks. So the question is, 𝐼𝐍 Limited issued 500 convertible loan notes on 1st January 2018 at par. They were issued at par. Each loan note is redeemable in 3 years' time. In 3 years' time at its par value of shillings 2,000 per note. Alternatively, each note can be converted at the maturity date on 1st January 2021 into 125 shillings 10 ordinary shares. And then in this case, we are told that their own notes pay interest annually in arrears at a coupon interest rate based on the nominal value of 6%. The prevailing market interest rate for 3 years loan notes without conversion rate is 9%. So what are we required to do here? We are required to prepare the extract of financial statements of 𝐼𝐍 Limited for each of the year ended 31st of December 2018, 2019, and 2020. The marks allocated here were 6. Now, what is important first of all here? So the first thing, or basically the first important thing to do here is basically to see that these loan stock or these loan notes which were issued by our company, they are convertible. They are what? Convertible, because we are told the company which is called 𝐼𝐍 Limited issued convertible loan notes. So anytime you see the word convertible, what you need to remember very fast is that this is a compound financial instrument. This is what? A CFI. Because I've said all convertible securities, all convertible debt instruments, they contain both equity and liability components. Therefore, on the date they were issued, what our company was supposed to do here is to split the equity component and the liability component. So therefore, maybe here we can say that these convertible loan notes issued by 𝐼𝐍 Limited. 𝐼𝐍 Limited is a compound financial instrument. So having known that, then you need to recall what you have said. We have said, according to IS 32, on the date of the issue, the company should split the equity component and the liability component. The company should split the equity component and the liability component. Equally here, we have discussed the 2 steps to be followed, basically in computation of the same. So what I want us to do is we basically go straight to splitting the equity and liability component. And we are going to start by computing the liability component. Step number 1 we have said is to compute the liability component. And actually this one is always computed on the date of the issue. So when were these compound financial instruments issued? They were issued on 1st of January 2018. 1st January 2018. That's when we should do the split. So how do we compute this liability component? The liability component you have said is equal to the present value of the annual interest, present value of the annual interest plus the present value of the principal amount. So if you can be able to remember that, then it becomes quite simple. So we need to first of all compute how much interest will be paid by a company on annual basis, how much amount will be paid on redemption, because you have said the principal amount is the amount to be paid once this convertible loan stock matures and they are redeemed. So first of all, to compute this one, to compute the annual interest, or basically in other terms, the interest to be paid annually, the interest per annum. How do we compute this one? This formula is very important. You must recall this. This one is computed by taking the coupon rate times the par value. The par value is also known as the nominal value. It is also known as the face value. The face value of the compound financial instrument. That formula, very, very important for computing the interest to be paid on annual basis. The coupon rate times the par, the nominal or the face value of this compound financial instrument. Remember, compound financial instrument are the 8% roll notes. Now, equally, if you check on this, the information which are given in this particular question, the information given in this question, you will see that we have two interests. Where do we have the first interest? The first interest is given, I think, in which paragraph? I think both of them are given in paragraph 2. Yes, can we go back to paragraph 2? In paragraph 2, we are told the roll notes pay interest annually in arrears at the coupon interest rate of 6%. So in our case, we already given the coupon interest rate. The coupon interest rate, which is 6%. But in most of the cases, the examiner will not tell you which interest rate is coupon rate. But if you're given something like this, you're given 10% convertible debentures. This particular interest, which comes before the name of the compound financial instrument, this is what we refer as the coupon rate. The coupon what? Rate. Yes, but in our case, we are told the coupon rate is 6%. So we multiply that with the par, nominal, or the face value of the CFI. CFI are the convertible loan stock. Now that information is given in paragraph 1. Can we go back to paragraph 1? In paragraph 1, you're told Naivasha Limited issued 500 convertible loan stock. 500 convertible loan stock. This is the number. The convertible notes issued were 500. And then you're told they were issued on 1st January 2018 at par. And then you're told each loan note is redeemable in 3 years' time at its par value of 2,000. So the par value of each loan note is how much? Is 2,000. So therefore, we need to multiply this coupon rate because we already have the coupon rate times the par value of the convertible notes. So we are told the convertible notes which were issued by the company, they were 500. But remember, this is just the number. We need to get the par value, the total par value of this. So what does that mean? It basically means that we have to multiply this with the par value of each, because we are told the par value of per row note, the par value per row note is 2,000. So meaning that the total par value of these row notes which were issued will be 500 times what? Times 2,000. So how much interest will be paid by our company on annual basis? On annual basis. So give me the final figure here. The interest to be paid by our company on annual basis would be how much? Will be how much? So which should be 6% of 500 times 2,000. Yes, I'm given a figure for what? Yes, I'm given a figure of 60,000. I'm given a figure for 60,000. So 60,000. So this is the interest which will be paid by our company per annum. And from the information which we are given here, this interest will be paid for the next how many years? Assuming these convertible notes will not be converted into ordinary shares. If they will not be converted into ordinary shares, this interest will be paid for the next how many years? This interest will be paid for the next how many years? Yes, automatically this one will be paid for the next 3 years, because we are told that this particular roll note will be redeemed after 3 years. So if they will not be converted into ordinary shares, the company will have to redeem them at the end of the 3rd year. Yes, so therefore this means that this interest, which is annual, will be paid in year 1, year 2, year 3. Also, we are told, I think in which paragraph? In paragraph 2, we are told this interest is payable in arrears. Payable in arrears means that it is payable at the end of each year. So the company will pay 60,000 at the end of year 1, at the end of year 2, at the end of year 3. So having that, then we need to determine this one, the principal amount. So that then we proceed and discount those two items and we add them. So what is the principal amount? Remember, the principal amount is the amount to be paid on redemption. Amount payable on redemption. Amount payable on what? On the redemption. So the amount to be paid on redemption, this one is always equal to the par value. To the par value. If you have invested 2 million in treasury bonds, once they mature, you should be given back your 2 million. Sasa? Yes, so they're redeemable at par value unless otherwise stated. Unless otherwise stated. So there are some questions you may come across and you're told that this compound financial instrument will be redeemed maybe at a premium of 10,000. So if they will be redeemed at a premium of 10,000, you take the par value, like in this case, the par value will be $1 million, plus now the premium, plus the premium. That is the amount to be paid on redemption. But if the question is cited, the amount to be given back on principal on the redemption should be equal to the par. Although in this question we are given that information. Paragraph 1. Paragraph 1, sentence 2, we are told each loan note is redeemable in 3 years' time. In 3 years' time at its par value. So the amount to be paid on redemption is the par value. So the par value in our case we know is equal to 2,000 per loan note, this one, and then times the total number of loan notes which were issued. So this should give us $1 million. $1 million. So the amount to be paid on redemption will be how much? Will be $1 million. So what we need to do now, because we have the annual interest, we have the principal amount, we just need to discount them. So there are so many, there are a number of approaches we can be able to use to discount this. Let me use an easier one, whereby we are going to have years, year 1, year 2, year 3. Because we know that in year 1, year 2, year 3, the company will pay this. And then also at the end of year 3, the company will pay how much? 1 million. So, and then here we can have like what? We can just refer to this as cash flows, the amount to be paid by our company. So in year 1, our company will pay 60 million, the annual interest. Because we have said this interest we have said it will be paid in year 1, year 2, year 3. 60 million, 60,000, 60,000, 60,000. And then at the end of year 3 here, once they mature, the company will also pay back the principal amount. That is what we need to know. The amount to be paid at the end of year 1, 60, at the end of year 3, 60 plus $1 million. Yes, I'm saying we refer to those as cash flows. So then in year 3, we are saying the amount to be paid here will be $1 million plus 60,000. Plus 60,000. So what do we need to do? We need to discount this. So to discount this, we need to multiply this with something called the present value interest factor. Interest factor, which rate are we going to use here? The rate we are going to use is something called the effective interest rate. If you check on that question, we also given another rate other than this, the coupon rate of 6%. In paragraph 2, we are told paragraph 2, the last sentence, the prevailing market interest rate for 3 years loan notes without conversion option is 9%. So that 9% is the one which we use for discounting here. So we multiply this with the present value interest factor at the rate of 9%. This one should be 9%. This one should be 9%. So how do we compute these values? Mostly in financial reporting, you not be given those present value interest factors tables. So you must remember the formula. So the formula for this is 1 plus R raised to power negative N. 1 plus R raised to power negative N. For example, in the first year here, the first year, our present value interest factor will be equal to 1. Remember, our R is 9%, 1.09 raised to power negative 1. Our N is this is N here. In year 2, 1.09 raised to power negative 2. In year 3, 1.09 raised to power negative 3. Raised to power negative 3. So in year 1, I hope that is the value which I'm given, 0.9174. What about year 2? Year 2, this is how we computed 1.09 raised to power negative 2, 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 that is 0.8417. Yes, you give me that figure to the nearest 4 decimal places. And the last one I'm given Diana here, 0.7722. Yes, having that, then we need to proceed and we compute the present values. The present values would be whatever you have here times the present value interest factor. So what are we going to have for the first year? The first year, 60,000 times 0.9174, 55,044. 55,044. What about year 2? 60,000 times 0.8417, which will give us 50,502. Year 3, 1,060,000 times 0.7722. I'm given by Eddie here, 818. Huh? Which figure is correct? The figure from Eddie, the figure from Diana? Yes, should be 818, 532. 532. Then what we need to do basically is now we add this. Remember what we are computing here. What are we computing? We are computing the liability component. The liability component we are saying is the present value of the annual interest. The annual interest is 60, 60, 60. That is the annual interest plus the present value of the principal amount. Principal amount 1 million, you have said. This one will be paid at the end of year 3. So let's compute this liability component. This liability component on the date of the issue, which is this date here, 1st January 2018. What are you getting as the total? You add all this. You add those figures. You give me the total. 924. 924, 078. 078. That is the figure I'm getting from Mercy here. I'm also getting the same from Diana. So what we have there, therefore, is the liability component. So having the liability component, then what do we need to do? Step number 2, because we are done with step 1. Step number 2, we need to proceed and we do what? We compute the equity component. Remember, basically, this part of the workings, we have not yet answered our question. If you take on what the examiner was requiring, we do what? We prepare financial statement extract. So will the approach in liability, in computing the liability component, be different if interest is paid at the beginning of the interest? Yes, it would be different, but practically, is it possible for interest to be paid at the start? No, profit is payable at the end because you have invested. The company can only pay you interest based on the profit. Based on the profit. Though there are those particular short-term government securities, treasury bills, the interest is payable in advance. Yes, for the short term. But I think this long term, the interest is payable at the end. It is payable at the end. Yes. So let's move and we compute the equity component. Equity component will also be computed on this date, the date of the issue, 1st January 2018. So how do we compute this one? So remember, I've given you the formula, the total proceeds, the amount received minus the liability component, which we computed in step 1. The liability component computed in step 1 is what we have here. 924, 078. So we need to determine how much amount was received. This convertible loan notes, how are they issued by the company? If you go back to the information which are given in this particular question, specifically in paragraph 1, you're told Naivasha Limited issued 500,000, 500, not 5,000, 500 convertible notes on 1st January 2018 at par. They were issued at par. They were issued at par. So the amount which was received, the amount received here will be equal to 500. And basically, we know the par value for each is 2,000. So the amount received was $1 million. This is the amount received by the company, 1 million. So we take 1 million, the amount received, minus the liability component. Whatever you get here, this one is known as the equity component. The equity component still on 1st January 2018. So what will be the equity component on the date of the issue? The equity component, the difference between 1 million and 924,078. What are you getting here? 229. 75 what? 75,922. 75,922. Yes, so that is the equity component. If you can be able to recall, we said the value for this equity component will not change in year 1, year 2, year 3. That value does not change. But now, this one, which basically is the liability component, this one we have said we must do what? This one we have to amortize it. We have to do what? This one we have to amortize it. This one must be amortized. This one must be what? Amortized. This one has to be amortized. So how do we amortize a liability in this case? From what you did in financial reporting, how do we amortize this? How do we amortize our own? How do we amortize something like a risk liability? What do we have to prepare here? We prepare something called what? Even when amortizing our own, you prepare something called the amortization schedule. The amortization schedule. So we need to prepare amortization schedule because we have not yet answered our question. If that question you leave it like that, you'll not be able to score the marks. So the question was requiring what? We prepare financial statements extract. We basically show what the company was supposed to account for in the income statement for 3 years and what the company was supposed to account for in the statement of financial position for 3 years. For us to be able to do that, we must first of all amortize this because there are a number of things we are going to compute from that amortization schedule, which the company was supposed to account for, both in the income statement and the statement of financial position. So what I want us to do, I want us to amortize this liability here. We amortize the liability. And basically to amortize this, we have to prepare something called the amortization schedule. So to some extent, it's almost the same with their own amortization schedule because this is now what you want to gradually write off, such that at the end of year 3, it should be 0. So here we have various columns. The first column will be for the years. So we may decide to use year 1, year 2, year 3, year 4, but basically we know that the first year started on this date, 1st January 2018. So it means that the first year will end 31st of December 2018. The second year, 31st of December 2019. The other year, 31st of December 2020. So what do we want to amortize? This one, the liability. So the first column here will be for the liability at the start. The liability at the start, and take into account the interest is payable in arrears. The interest is payable in arrears. The next column here should be for the interest. Should be for the interest. And actually this interest, always we compute it based on the coupon, we compute it based on the effective interest rate, the market interest rate. If you can be able to recall our effective interest rate, the rate we have used for discounting was 9%. That is, we compute this interest based on this market interest rate, not the coupon rate, the market interest rate. And then here we have the cash paid, and then we will have the last column here, which is the liability at the end of the year. Remember, this is just like Karun. This is just like Karun. How do you compute the loan balance at the end of the year? To compute the loan balance at the end of the year is very simple. You take the loan balance at the start, you add the interest, and then you less the installment you paid. You less the installment you paid, you'll be able to get the loan balance at the end. So that loan balance at the end of year 1 will become the loan balance at the start of year 2. Compute interest, deduct the cash which was paid, you compute this one. And actually computing the loan balance at the end, you take the loan balance at the start plus interest minus cash paid. Minus cash paid minus cash paid. Yes, so in this case, here we don't talk of installment. This cash here is the same with installment. Is the same with installment. But equally in this case, if you can be able to remember in FM, financial management, you compute the installment which is paid, and that installment, I think you split it, you go ahead and split it into two. The principal amount and the interest. Is that the case? That's what you do. Here we don't have to do that. We don't have to split the installment paid in form of interest, in form of principal amount. Yes. So the liability at the start of the year, because what we start here should be the liability at the start of year 1, is what we have computed here. That is the amount we want to amortize. 924,078. So that is what we want to amortize up to the end of year 3. At the end of year 3 should be 0. So then we compute the interest. The interest should be 9% of this, 9% of the liability at the start. So that will be an amount of how much? That will be an amount of how much? An amount of how much? An amount of how much? Amount of how much? 80? Is it 83, 87? Are you getting 83 or 87? I'm getting different figures there from Diana, from yes, 80. What are you getting here, Patrick, somewhere? No, but which figure are you getting here? 83, 167. 83, 167, 167. I wanted to see whether we are together. Can someone tell me how much cash was paid by our company in year 1? Nataka nione kama tuko pamoja. Our company here, this company which had issued these 6%, is it 6%? 6% convertible loan notes. How much cash did it pay to the holders of those convertible loan notes? How much cash was paid? How much cash was paid? I see whether we are following what we are doing here. I see whether we are together. The cash paid by our company is what we have here. These are the cash paid by our company, year 1, year 2, year 3. Yes. So the cash paid here was 60. So how do we compute the liability at the end of the year? Remember, I've said it's just like a loan. So this is the loan balance at the start. This is the interest charged during that year. This is the cash paid. To compute the loan balance at the end, we take the loan balance at the start. We add the interest for that year. We minus whatever was paid. So therefore, this one will be equal to this plus this minus cash paid. The amount to be deducted, we put it inside the bracket. Give me the liability at the end of that year. Yes, what are you getting? Gordon, it cannot be 231. It can't be 231. That one automatically is wrong. It should be around 900 and something. 940, 947, 47 to 45, 245. So that will be the opening balance in the following year. 947 to 45. And then we compute interest here as 9%. We compute interest here as 9%. Yes, what are you getting? The interest, 9% of this, 85 to 52. 85 to 52. The cash paid also is 60. So give me the liability at the end of year 2. The liability at the end of year 2. Yes, we're getting the liability at the end of year 2. The liability at the end of year 2, 972, 497. 497, that will be the opening balance now here. 972, 497. So the interest, which will be 9% of this, 9% of this, 9%, 87, 524, 524. Now, we know at the end of year 3, the company is supposed to redeem them. The company is supposed to redeem them. So we are saying to compute this one, liability. We are saying this just like a loan. This was your loan at the start. This is the interest you are charged, but you paid this. You paid this. How do you compute the loan balance at the end? You take the loan balance at the start plus interest minus this. So this one is computed by taking A plus B minus C. This loan balance plus interest minus cash paid. Sasa, yes, that's how we compute that one. How we compute that one. I hope that is understood now. Now, here we know the cash which was paid was 1,060,000. But if you check on the question here, when was the principal amount paid? The principal amount. Are we given the date when the principal amount was paid? The 1 million. When was 1 million payable? Because in most of the cases, we'll be told it will not be paid exactly on 31st of December 2020, but you can be told it will be paid on 1st January of 2021. I think that's what we were told. This 1 million, when will the redemption take place? Yes, the redemption, this 1 million will not be paid at the end of this year, but will be paid the following year, the following day actually. So therefore, in preparing our amortization schedule, what we put here is 60, because at the end of the year, will the company pay 1,060,000? No, the company will only pay interest. And basically, it means that once you prepare this, even without computing this, here you should be left with 1 million. You should be left with 1 million, and this 1 million will be paid on 1st January of 2021. That is when it will be paid. So therefore, it was not paid here. That's why we are not including 1 million. So, but if the question is silent regarding when this amount will be paid, regarding when this debt instrument will be redeemed, then we would have included 1,060,000. Are we together? Yes. Are you getting 1 million there? You may get a figure which is not exactly a million because we have rounded off, but it should be a figure of 999 something. Are you getting 1 million, or are you getting a figure of 99? Yes, it should be 1 million. This one will be paid in the following day. Now, having that, we can wind up the question now by doing what? By answering our question. So what are we required to do? We are required to prepare financial statement extract. Financial statement comprises of the income statement, comprises of the statement of financial position. We need to prepare income statement extract. Remember, an extract is part of something. Is part of the income statement. This is not the complete income statement. We are preparing this income statement to show what was supposed to be included in this income statement for 3 years in relation to this compound financial instrument. So let's do that. We prepare income statement extract. Basically to show what the company was supposed to recognize here for 3 years. The first year ended 31st December 2018, 31st December 2019, 31st of December 2020. And what the company was supposed to recognize in the income statement is this interest. This interest. So this interest should be recognized in the income statement as part of the finance cost. As part of the finance cost. So therefore, in the income statement, specifically at the expenses, the company was supposed to recognize this interest, but basically any form of interest will be recognized in the income statement as part of the finance cost. As part of the finance cost. So therefore, the finance cost for the first year is this one, 83,167. In year 2, this one, 85,252, and year 3, 87,524. 524. That is what was supposed to be recognized in the income statement as far as these compound financial instruments are concerned. What about the statement of financial position? Remember, this is still an extract. This is an extract. This part of is not a complete statement of financial position. So equally for 3 years, 31st December 2018, 31st December 2019, 31st December 2020. So in the statement of financial position, our company basically here was supposed to recognize two items. One, the liability component of this convertible loan notes, and number two, the equity component. So two items. And the first item, basically what we know is that in preparing this, we record assets, non-current, current, we record equity, followed by liability. So in this case, because we don't have any item of assets, we basically start by showing what was supposed to be recognized here as part of equity, and what the company was supposed to recognize here at the equity is this one, this equity component. Remember, we have said the value for equity component remains unchanged in year 1, year 2, year 3. That one will not change. That's why we said it remained constant. So at the equity, the company was supposed to recognize something called the equity component of the convertible loan notes. So make sure you write that in full. Equity component of convertible loan notes. Equity component of convertible loan notes. The value for that is 75,922. This one we are saying will not change over the period of 3 years. That one remain the same. That one remain the same. This one remain the same. Then other liabilities, the company will recognize something called the liability component of the convertible loan notes. The liability component of convertible loan notes. And where do we get these values to be recognized as the liabilities? We get those values here from the amortization schedule. So from this amortization schedule. So this is the liability which was supposed to be recognized in year 1. 947, 245. That one. Year 2, this one, which is the 972, 497. And year 3, this one, 1 million. 1 million like that. 1 million like that. 1 million like that. 1 million like that. Yes. $1 million like that. And basically that's what was required as far as that question is concerned. All what you have done, all this was part of working. So the marks are allocated here. This is what will earn you the marks. This is what will earn you the marks. This is what will earn you the marks. Though in this particular question, the examiner was too mean. I've said there was a question which was tested on this in FR. Maybe for those who are my students in FR, we did such a question. And that question, the marks allocated in that question were 10. So, but this question, the marks allocated were 6. This is a question basically, the examiner should give at least 8 marks because you can see the question is a little bit demanding. Yes, so that is it. That basically what is required as far as that question is concerned. I hope if you come across a similar question, you can be able to handle it. That. But I've said what is important as far as this is concerned is basically anytime you see the word convertible, what you need to remember very fast is that is a compound financial instrument. If it is a compound financial instrument, you must go ahead and basically do what? Split the equity component and the liability component. The equity component and the liability component, and then from there you must proceed and you do what? You amortize the liability component, and then for the equity component you have said that value remain the same. I want to give the question for from 𝐻𝐿 as an assignment. I think this was from the sitting of August 2024, from the paper for financial reporting, intermediate level. Let me share that question with you. Is it August? Let me see. No, it was basically April, although let me do a screenshot. Yes, so I've shared that question in the class WhatsApp group. The question from financial reporting and analysis. From financial reporting and analysis, this was a question for April 2024. Specifically, this was question 5. I think question 5B. Question 5B is basically the same. Is the same with whatever you have done here, because we are told that company, which is called 𝐍𝐿, had issued a 9% convertible loan notes. 9% convertible loan notes. And basically what the examiner was requiring here is with suitable calculations demonstrate the accounting treatment of the above transactions in the books of accounts. So if you're required to demonstrate the accounting treatment in the financial statement, you are required to prepare financial statement extract, just like what you have done here. Then I hope you have seen that question which I've shared with you. If you go to still to the question, I've already shared the question in the class WhatsApp group. If you go to that particular question in the requirement, you are told to round off your answers to the nearest 1,000 of shillings. To the nearest 1,000 of shillings. So if you're given those instructions by the examiner that you round off your answers to the nearest 1,000 of shillings, round off answers to nearest 1,000 of what? 1,000 of shillings. So basically what that means is that when, for example, preparing the amortization, say you what you do, you work your figures with 1,000 of shillings. With 1,000 of shillings, that means that any figure which you have, you omit the last 3 zeros. You omit the last 3 zeros, and any figure having a decimal, you round it off to the nearest whole number. Sasa? Yes. So in that case, you will not work with the full figures, but you work with the figures in 1,000 of shillings. For any figure which you get, let me give an example of what I mean here. So like if you take on that particular question in paragraph 1, you're told this company issued convertible loan stock having a value of 120 million. 120 million like that. So when working out this question, you do not work with this particular whole figure, but what you'll do, you'll omit the last 3 zeros. But for example, in preparing the amortizations that you have there, you must note that your figures are 1,000 of shillings. When preparing this income statement of financial position, you must come here and you note your figures are in 1,000 of shillings like that. Are in 1,000 of shillings like that. And if you come across a figure having decimals, you must round off to the nearest whole number. To the nearest whole what? Number. Sasa? Yes. So I want to give that particular question as an assignment. And also for today, I want us to stop at that point. I can see we have around 15 minutes. We can't be able to do something constructive. So once we meet in our next session, we will be able to talk about types of financial assets, the classification of financial assets, and also we talk about financial liabilities. And then from there, we will be able to look on some questions from what? From the past papers. So I don't know whether there is any question before we wind up. Is there any question before we wind up?